We do our monthly OPEX call. How you doing, Imran?
I'm good, man. How are you?
Great. Been busy lately. We've obviously had a lot of wild moves in the market, and I don't think we're done yet. The consensus here seems to be that everything is all clear. We had a big market rally yesterday after the record VIX spike last week, and big moves in correlation and the yen and all sorts of other stuff. We've mean reverted largely from those moves, but we got a lot of stuff coming up. So we have a lot of fascinating things to cover today. Excited to have your view. Obviously, you sit over there in London and you cover a little bit more of the macro side than I do, so I know you're going to have a lot of great things to add there. Before we dive in, Imran and I started recently doing a subscriber webinar to talk specifically about OPEX positions and trades we like to enter. If you want to join that conversation, what you're going to do is you're going to go to spotgamma.com/OPEX. You can also click the little QR code up in the top of your screen, whichever direction that is. You're going to get a spreadsheet which details all the latest options positioning, as well as access to the Zoom channel where we're going to do that webinar. It's 10 o'clock Eastern, so we're going to be doing that just after this call. So make sure you grab that link. And enough of me yapping. Let's move over to the markets. So Imran, yesterday we had, let's start another step earlier. How about that? Last week, we had this very large move, and I think this has largely been talked to death. But I want to add just a little bit of context about this because I think the positioning is important. After July options expiration, in fact, if you look at this, this is Wednesday, July 17th. Imran, what's so important about Wednesday, July 17th? What happened that day? Do you remember? VIX expiration.
VIX, yeah, exactly.
That marked the high of this market.
I was going to say that, but you caught me drinking water.
I caught you drinking, yeah. I wait till you take a sip of something to ask you a question. So we had really a big move. The reason I bring this up is because we entered the fabled negative gamma position at 5,500. That's where it initially onset, and we really spilled over. And then obviously, the yen carry trade seemed to create these correlation spasms and some vol covering and things like that. And what is lost a little bit because everyone focuses on this huge VIX spike that you see on your screen here is that the market really was getting pounded kind of, into that Friday time period. We had 3.5% decline in the market. The VIX was at 20. The VIX at 20 was the first time since roughly April, but that 3.5% drawdown was one of the bigger drawdowns we had over the previous months, right? And so now we've, in my view, mean reverted from that move. We're a little bit over that now as the S&P rallied yesterday, and the VIX now is back under 20. What's your sort of just quick take on what happened over the last week or two? I've voiced my opinion on this so many times. I don't want to bore people with that again, but I'd like to hear, how you viewed things over the last week.
Yeah, so there was some fragility building for a while now, right? So you had the little spark that was all the shenanigans that happened in Japan as they move rates, and it did trigger a bit of a cascading unwind. But you had started to see carry trades being unwound. You had started to see some of those emerging market currencies like Mexican peso was already starting to unwind, and so you were starting to see de-risking going on. We had that big short cover on Russell as well, which was a form of de-risking as well that was going on. So this was kind of like the crescendo where Nikkei like gapped down 10% plus, and it just panicked everyone. And then we obviously saw this massive VIX spike. Obviously, a lot of short vol strategies were around that would have got hurt on that. Some would have got stopped out, but then some may have actually managed to survive because they've been doing so well for so long that if they could stomach the drawdown, then maybe they were actually able to survive, right? And what I did see from some of the people plugged into that space on Twitter was that actually people who survived were then able to sell into that spike and double down on that trade. And I think that partly explains why we are seeing vol collapsing so fast right now, right? So the VIX is literally back on a 17 handle, and it was like it was all a dream, right? So my personal MO is not to go and slap a load of VIX futures just because they've doubled, because that is dangerous because they can double again. So I prefer to do it via VIX puts and VIX put structures like I have been doing with my community, which are working really well. but there are people who are a bit more aggressive who are willing to sell it in just straight outright stuff. And look at that gravity. I call it the VIX gravity. We know it always does kick in at some point, but the speed at which the VIX gravity kicks in is pretty amazing, and often surprises you how quickly it comes back. I can't hear you if you're speaking.
Apologies for that. I had to hit mute. I want to dig into this concept of sinking volatility. In our founders note this morning, we talked about the decline in vol. And I want to say this because I thought that vol would be sticky, implied vol would be sticky, and the basic way I would say to watch that would be VIX holding 20. Well, clearly I'm wrong on that as the VIX is really dropped rather sharply over the last couple of days, seemingly off of PPI, right? And I want your take on this. We looked at fixed strike vol this morning. We said not so fast on taking the L with the call on sticky vols, because if you look at our fixed strike vol matrix, what I want to show everybody here is the change in implied vols from Monday, which was Monday night, versus this morning, and vols have changed a little bit from when I wrote my note this morning because CPI passed. But I'm feeling pretty safe to say that we'll get a rough idea here. So I'm going to zoom out. Sorry, everybody, stick with me. There's a point coming here.
No worries.
All right, so this is the change in implied vol for all strikes, right? So short dated vols have increased since Monday night, August 12th to this morning. But when you look at shorter dated implied vols, they're starting to move now after CPI, and now we're down about 1.6 vol points here. But this morning, these were fractionally down. You would talk about 0.3 vol points. And so what my point was is that if you look at vol from a fixed strike perspective, and I could show this in another way here with skew, is that it was not really dropping that much relative to what you'd see kind of like in the VIX, where everyone's like, hey, look, the VIX just went from 50 plus down to 17. Vol is collapsing. But when you look at fixed strike vol, it's not really, it wasn't or is not doing the same thing. And the reason I bring that up is because I think that it implies that there is an embedded risk remaining in this market and that things are not all clear. I'm going to get up this plot. It's hard to do this and talk at the same time. So I'm dragging this point out here a little bit, but here we go. So this is the change in fixed strike vol for 1 month skew, specifically 9/13 expiration. So I'm comparing the same expiration from Monday night to right now. And CPI's, benign impact did drop vol a little bit here. So we need to be clear on that. But look at this change in vol. I mean, what do you make of this when you compare this versus what you see kind of in the VIX space where things have dropped a lot more? So gray is Monday night, teal is today. So we just, with CPI passing, started to lose a little vol. How do you compare, say, the VIX and the VIX complex versus fixed strike vol in this situation?
Yeah, I mean, the point on the way down, that massive VIX spike, it's a similar story, right? It's like as you're traveling down that surface, that is a large reason why the VIX is rising, right? So
yes,
then as you rally back along that surface, again, that's a large reason why the VIX is falling. So the fixed strike moves on the surface tend to be much smaller than the absolute VIX move, because the absolute VIX move has two dimensions. It has the dimension of you sliding up and down the surface, and then it has the dimension of the surface itself shifting higher or shifting lower, basically, right? So the VIX encompasses all of that excess volatility of those two dimensions, whereas the fixed strike only encompasses the surface shifting. And why that's really useful to look at is that it gives us a sense of positioning. So when we see fixed strike vol gapping up like 5 vols on a day when the market's breaking support, we know that street positioning has flipped probably into very short vol territory, right? Because it was long for ages. We break key levels. Skew's been going bid, telling us that puts are getting bought, and suddenly, boom, fixed strike vol explodes because we go down. So that's telling us that all the dealers have moved from being long local to being short stuff that has been lifted off them when the skew was getting bought. and now you've gone to those strikes or closer to those strikes, and the vol on those strikes has exploded, the Vega exposure, and that's made them want to then cover vol and drive fixed strike vol higher. So it's the positioning indication that fixed strike vol really gives you, which you don't really get from the VIX, because the VIX is too noisy, because a lot of it is you just moving down the surface.
Yeah. And we drew the down the surface. So excellent explanation. I know I threw a curveball at you there, but this is that skew change from this morning. So on Monday's close, we're at 53.38 in the S&P. That at the money strike had an implied vol of 17%. With the market rally yesterday to 54.35, we saw that at the money vol was 15%. So that gives you, when you look at term structure, like here, you have the perception that there was this kind of big collapse in vol, just like there was a big drop in the VIX. And while the VIX did go lower, that fixed strike vol is telling, in my view, a slightly different picture. And I think a lot of that is because we had CPI have it, we have retail sales, and then the Jackson Hole is next week, right? And so there's likely to be some vol holding because of that event. So when you change the main input in the VIX from 17 to 15, the VIX is naturally going to go down, even though that doesn't necessarily mean that implied vol in the S&P has dropped.
Yeah, I mean, the way I like to kind of say it when I teach people about VIX is like, think of the VIX as just the at-the-money vol on S&P plus a number. And that number is quite stable usually. It's around 3 or 4 vol points. So whatever the at-the-money S&P vol is on 1 month expiry plus 3 or 4 vol points, that equals the VIX number, right? So if by definition we go from 5,400 to 5,000, the at-the-money on S&P has changed significantly, right? And then you add the 3 or 4 vol points to that new at the money, and that's where the VIX should be, roughly. Now, sometimes that 3 or 4 can turn into 5 or 6 because the convexity and the smile and the skew all goes ballistic like it did last week.
Yeah.
So that spread can get even bigger, but usually that doesn't last for very long.
There's a very, very interesting idea there. I had not thought of it like that. So let's pivot slightly to where the positions are now, rather than reviewing what's going forward. If we do look at the aforementioned term structure here into options expiration, let me pause before we do that and just talk about this expiration. It's not a very big expiration. If we look at our charts here, this is what we call expiration concentration. This is the size of deltas for puts in blue versus calls in orange for the major indices. And what was interesting is on last Monday, this was very put heavy, right? Everyone was in puts, and that was all the flow was focused around puts. And now we're actually more in calls than we are in puts into this expiration, which is a little bit surprising given the kind of carnage that has happened. So people very quickly were chasing this on a short-dated positioning metric. Everyone was trying to aggressively buy the dip because we've all been sort of in a Pavlovian fashion trained to do so, and that trade continues to work out, right? I admittedly was more skeptical about full VIX collapse and market rebound. Certainly up over the current level of the S&P, like really pressed up where I thought the high was going to be. But I think that there's still these risks that are lurking, right? And I don't think there's that much stability. So the point here is this OPEX, I'm the first one to pound the table, and this is the most important thing you need to watch. This one, not so much. Certainly on some individual stocks, it's interesting, which is what we're going to be talking about at the webinar after this. But what I think is more interesting is the macro side of things, and I'd like to get your picture on this a little bit. So if we look at term structure here in the S&P, what we'll see obviously is that vols have come down a lot. They were well above their 90-day range, and we could see that we had CPI this morning. We have retail sales, which is being watched, and then what's going to come up next week is Jackson Hole. That's the biggest date on 8/24, and then we have Nvidia earnings right after that. And so I think the macro picture here, which to me is very interesting, because only 2 weeks ago, we had this jobs data that came out that really seemed to trigger a big market slide before we got the yen issue, right? People are talking about Airbnb was terrible earnings and Home Depot weren't very good earnings. And suddenly people were really worried about a recession. You don't hear that being discussed all of a sudden in the last few days. I haven't looked at the CME tool in the last couple of days, but as of Monday morning, we are getting a 100% odds of a 50 bips, of a rate cut. So people are saying, hey, we're definitely getting a rate cut. The question is, are we getting 25 bips or are we getting 50 bips? And so we're watching for some sort of signal from that for next week from Jackson Hole. for what's going to happen at the mid-September FOMC. And so the thing that I'm trying to parse here is if we get a 50 bips rate cut, and I don't know if this has changed again, it's probably because we're going into a recession, and you wouldn't really probably want to own small caps in that situation, right? But maybe we're just going to get a 25 bips rate cut because things aren't actually that bad, which maybe is good for small caps. And then adding to that complication is Nvidia earnings, where what the interesting analogy is, and I know I'm going on a lot for you to have to parse all this, Imran, but if you look back at, let's show this chart. The last time that we had a 2% rally in the S&P 500 was in February when Nvidia, hit like a grand slam on their earnings. And that's assumed that they're going to do that, generally speaking, going forward. So there is the Goldilocks scenario. We get a 25 bips rate cut, Nvidia crushes it, and people forget about any kind of recession thing. Then there's the other side of the coin where we need 50 because maybe things aren't so great, in which case I would think that would be equity market negative. I said a lot there, Imran. What do you think about this macro?
Look, the sell-off was also partly due to this idea that Harris is going to be less market-friendly than Trump, right? And her odds have been increasing materially, right? So she's apparently in the lead in the polls. So some of the equity market weakness was on the back of that, but we have recovered. We are rallying. I agree with you that a 25 bip cut is actually a better signaling for the market than a 50 bip cut, because you're probably only going to have to accelerate and go 50 if the world's in a shitty state. And how good is that shitty state going to be for stocks? Certainly not great for mid caps. The tech stocks have got a habit of just ignoring it and not caring, because as long as the liquidity taps are on, when the economy is weak enough to justify turning the taps on liquidity wise, that's when all these mega cap techs do fine, basically, right? They actually work. They actually do quite well. It's that debasement trade that goes on, right, in all assets, particularly those assets that have like tech companies that have got some pricing power and stuff like that. So, I think it's interesting that we are now nailed on definitely for a cut. I thought it was going to be 25 anyway. The market got spooked and we started to go more. I think it makes sense that Powell's going to guide towards 25 in Jackson Hole. So if he guides towards 25 in Jackson Hole, then the rates pricing needs to shift back towards maybe 80% 25 or something like that. If it does that, that probably at the margin is equity negative because it's less liquidity, right? But that is probably a dip to be bought, right? Because if he's only cutting 25, then it means that we're in an okay state anyway, right? So I'd say any dips that you get on a Jackson Hole that guides towards 25 are dips to be bought in equities. And then
we're still pretty much 50-50, a little bit more of an edge, just 25 bips cut as of this morning.
Nvidia earnings, God knows. I mean, it's implying a 10% move. A 10% move. I mean, the stock's already recovered half the sell-off, right? From like 140 to 90. It's already recovered half of that. So I don't know how much is stock up today, or is it up even?
No, it's down a little. We tagged 118 and we're down a little bit today.
Yeah. So
incredible move, though. I mean, to your point.
Yeah, I wouldn't be surprised if the stock keeps charging higher. The whole semi space is bouncing quite viciously. It's one of those things. A lot of people who would have missed the boat in the semis are like now wanting to get back into this trade, right? Thinking that the AI story is not gone away. These are on a strong uptrend. They had a big correction, and if that trend resumes, just from a technical chartist perspective, it's like the trend is clearly up. Like no one's going to deny that looking at a chart. I mean, when you zoom out. If that was a complete correction of some kind, then a minimum target has to be the highs that were reached before at 140. And realistically, we probably push through that target by year end if this trend resumes. And maybe we're looking at 160 plus in Nvidia, right? So that is, the earnings are going to kind of guide us as to how soon that transpires. But unless this thing is topped out and the trend is reversed, which I don't think we've got enough signs to tell us that yet. Then that could well be a bullish catalyst for the market.
And if they miss or come in under expectations, that would be, I think a major problem for the market, obviously, because Nvidia is still 6-7% of the S&P 500, still, a huge component of the NASDAQ, same size. And then, what does that signal for the whole AI trade, which is what a lot of the market bounce is related to? Incidentally, if you're interested in looking at what the implied moves are, Imran mentioned that earlier. If you go to spotgamma.com, you go to free resources, you can see this chart. But this is our chart of forward earnings implied moves. And so if we just zoom way out here, we could see. I thought in. Let's see
Nvidia's on the
Nvidia on here yet, but
so it's on the
Nvidia's on the
28th, I think, of August.
Yeah, there it is. Sorry, it's on the 28th. I've been saying 27th. That's what's confusing me. So 11% is this morning's implied move there. Also CrowdStrike on that day. So big tech day coming up here. You got it's like Walmart next week, so maybe that gives us or Walmart tomorrow rather. So maybe that gives us a little bit extra macro stuff. Let's pivot real quick to this idea of the correlation trade, and I clearly there was what we had called, or what we've been referring to as, a correlation spasm that occurred on Friday. And, this correlation metric, which comes from the SIBO, is forward looking, meaning it's using options 1 month in time to, for estimated correlation, which is telling us what is the implied vol of single stocks versus the implied vol of the index. And so, in the bizarre markets that we had on Monday morning, obviously this correlation index spiked in a massive way. And now we're kind of mean reverting. And my view on this is that I think that this could be kind of the end of this correlation trade as we know it, because it had gotten to such an extreme. We broke 2017 levels in terms of this correlation metric. And the other thing that was interesting about this at the same time was the SIBO put out this interesting chart of single stock vol versus index vol, and it was at a record high. So I viewed that as, the correlation trade in whatever form you want to look at it, whether it's explicitly people trading single stock options versus index options, as well as the momentum factor, people piling into, momentum shares and semis, et cetera, had really maxed out, right? It hit this point where how much more value can you extract from this? And then when we go risk off, those single stock vols are not going to go down because those stocks are crashing, right? Like Nvidia and whatever had lost 10, 15, 20% over the course of a couple of days. Only you have single S&P vol rip, right? So suddenly it's like single stock vol remains high, and then things normalize or become more correlated by index vol rising or raising up. So long story short here, yes, this correlation trade is or this correlation metric is coming back down. And to your point, I think people were quick to want to sell vol, pile back into this trade of long single stock versus maybe S&P vol and buy the semis, et cetera. In my view of this is that, hey, I think this trade is going to change, because previous to this, when we had these little correlation spasms, there was no rate change backdrop, right? The recession was never really going to show up and stuff. And now I'm wondering if we are indeed going to get 25 or 50 bips worth of rate cuts. Do you think that people start to allocate into, cash or bonds or CDs or money market funds or whatever, trying to lock in some type of higher rate, or is that not really enough of a flow to matter?
So you're asking if people are going to stop doing this dispersion trade on the back of...
I think that the flows have been largely focused on which equity sector do I need to own to outperform the broad-based indices. So we went from semis were the best thing ever to small caps, that was the best thing ever. Which part of the equity complex do I need to own, to do I even want to continue owning equities, or is now a time where I need to try to allocate into bonds or, some type of other, yield instrument? And the reason I bring that up is because we had a situation over the past few days here where the 10-year dropped really sharply over the course of a few days, and the 60-40 portfolio, i.e. long spiders and long TLT, actually worked out pretty well. TLTs was as just a very crude metric of this. TLTs were up 4% while the spiders were down, were down 4%. So 60-40 had been dead for so long because no one thought we were actually going to get rate cuts, or it just didn't matter, or rates were going higher. And now we're going to get rate cuts. It's markets guaranteeing that, or pricing in 100% odds of that. And so does that change this dynamic a little bit? Like, if we're going to go into a recession, do you stop worrying about which equity sector do you own versus do you own equities at all?
See, I'm struggling to get that bearish. If growth data is rolling over, all it, we're not coming from a place where rates are really low, right? We're coming from a place where rates are quite high. So there's loads of room to cut.
Yes.
So as bad as the economy gets, they've got the firepower to cut rates, right?
Yes.
And them cutting rates, it is just embedded in, you know, in everyone. We've seen it so many times. When they cut rates, markets rally, right? So I don't know that liquidity dynamic has changed in markets. And if anything, the yen move, this is a bit of a macro one, right? But basically that yen move, that strengthening in yen, when the yen was super weak, it was making it really hard for China to stimulate and add liquidity to the market, right? Because it was going to hurt their currency, basically, right? And they needed to stay competitive relative to Japan. But if Japan's currency is massively strengthened now, that actually relieves the pressure on China, and China can stimulate and add liquidity to the market. And if they add liquidity, global liquidity rises. And what do we know what happens when global liquidity rises? Stock markets go up. So I don't think you're going to get a switch out of stocks. I think stocks and crypto are being supported by the fact that rates are coming down. They took a bit longer to come down than we thought they would because, you know, central banks were resisting because of stickier inflation. But as this growth data has started to crack and the labor market started to crack, that has given the central banks the green light, as well as disinflationary prints in terms of CPI and PPI. You know, all of those things are moving in the right direction that allows these central banks to turn those liquidity taps on again. And I think that's probably a net positive for markets.
It's a very interesting view. Certainly, you add a lot of stuff about the yen and related China trades that I certainly have no view or opinion on. So thank you for that. And someone here mentions Benjamin Groff mentions, you know, look at what happens when the Fed cuts rates. And I actually pulled this up in a recent presentation we had. It's sort of mixed, I guess. You know, recent history, I guess, wasn't too good. 2001 and 2007. But, you know, the 80s and 90s, it was good. So I don't know that I could stamp and say, hey, we always fall apart when the Fed actually starts to cut, which I guess is a little bit supportive of your point, Imran. And I think largely there's a decent support level down at S&P 5,000 in the short term. But almost to what you said is that we now have a relatively high level of rates. And so there is room to cut. And I guess that would support long bonds if we do continue to get cut, right?
Yeah.
So that would support 60-40, because if we're cutting, I just put in a horrible symbol, because if we're cutting that much because there's a recession, then I would assume that the economic backdrop suggests that stocks, you know, should kind of go down. So, you know, we'll see. I mean, I could very easily be wrong in this if Nvidia pulls out incredible earnings and suddenly everyone's piling back into the AI trade because Nvidia tells us that, you know, Apple and Microsoft and everybody else is buying, you know, processors or whatever hand over fist. So it'll definitely be an interesting, you know, couple of days coming ahead. And Imran, I would just say that per usual, what happens when we have these conversations, markets start breaking and we're
going lower. Yeah, they have ticked down. Someone's asking about, are rates really that low? I think the thing you've got to realize about rates is that the neutral level of rates just keeps going down as global debt rises exponentially, right? You can't have rates going back to 10% because everyone's screwed, right? So, you know, just look at Japan, right? They're probably the best example. Japan's debt is some stupid number, like I'm going to say 250% of GDP or whatever.
It
right?
is, yeah.
And it's like their rates went up 20 bips or whatever it was, and the market crapped itself, right? And now they're already saying, oh, we're not going to keep hiking rates if the markets are unstable, right? So there just is no real way. I mean, I was amazed that we managed to get back up to 5% rates in the US, to be fair, right? But so from a debt adjusted basis, I do think 5% rates are quite high. That's the point I'm making.
And I think that'll be fair. I would say that I have nothing of value to offer on these relative points, so I'm not going to enter the arena on this one. One that I can offer maybe a little bit better picture on is our buddy podcast. He says that, what do we think the VIX floor is for the foreseeable future? Well, I know Mr. Podcast reads our notes, and so I was saying VIX sticky at 20, which is a view that implied vol wouldn't come down. And when I look at fixed strike vol, like we were just discussing, I go, okay, well, I think it was actually right. Vol didn't come in that much, but clearly the VIX, has sunk below this key level. Not that it's necessarily key at 20, but we went below the level that I was mentioning, and now we're now back to these kind of start of August highs. Imran, do you see something that would be kind of a floor here? I mean, I would imagine that the rate of change in VIX would slow because we have Jackson Hole a week from now. But
it depends on the time horizon. But I'm expecting VIX to be sub 15 by middle of September. To be honest, that's my base case.
Yeah, because I mean, what do you do about if we stay 50-50 on this situation with what the rate cut is? You think it doesn't matter whether we get 50 or 25 out of the Fed, and so there's these situations where, like, are we going to get a rate cut, and so vol is going to be kind of maybe elevated due to that. Whereas, does it make it more uncertain if we're like, hey, we're definitely getting a rate cut, but if we get a 50 bips rate cut, that's saying something much more different. I mean, we just talked about this, but I would think vol would stay a little sticky for.
Maybe it would, yeah, exactly. 50 bit, but I think it's more the other way around. I think it's like we're only going to get a 50 bip cut if vol is high because the market has dumped, right? So it's like the vol move's already happened, right? It's not like we're going to get a 50 bip cut and then vol's going to spike, right? It's like we're only getting the 50 bip cut if the market sells off, vol goes up, and then we're in a stress state, and then the Fed comes to the rescue with a 50 bip rate cut, basically.
So can we say that the rate cut matters, all hinges on Nvidia earnings? If Nvidia earnings are a banger, then we're only going to get 25 bips. And if Nvidia earnings are bad, then we're going to get 50 bips.
I mean,
if Nvidia earnings are bad, I think market's going down.
Yeah, but I think the Fed will care about the macro data outside of just Nvidia earnings, right? So
they're not so stock dependent.
Huh?
Not terribly stock dependent.
No, I mean, clearly, like the Nvidia earnings will matter for where the S&P goes.
Mm-hmm.
So it's not, but the S&P does feature in a little bit, like they do care about what the market's doing, right? So if the market's falling out of bed because Nvidia disappoint, and that in itself triggers a bit of an equity market panic and more de-risking to the downside, it turns into a bit of a snowball, right? It's like then they're just trying to put out the fires. So if a fire is created, like the fire was created by Japan, and so there's now the thought that they're going to put out the fire by cutting more than they otherwise would have done, right? So I think it's that. If there's a catalyst like an Nvidia earnings that triggers another fire and equities do get sold, then yes, it increases the probability that they may come to the rescue with some sort of 50 bip cut if they think they can justify it by the damage that's been done across global stocks and the kind of sentiment driver that is. It's a massive sentiment driver, right? It's the wealth effect, all these things that feed through into macro data later down the line. If the equity market crashes 20%, that does feed into macro data in the future. And so that's why it's part of their reaction function, right? But if the equity market's doing its thing, grinding higher, not having any trouble, then we're much more likely to stay the course. All the data is pointing to the idea that growth is softer, inflation is also softer, so they can cut 25 in a nice orderly pace.
Yeah, and I think that order, particularly if we get good Nvidia earnings, then how do you not try to play higher markets? It is interesting to me that when we had this spasm, it was jobs data first that started to break things, and then immediately the attention goes to the end carry trade because that exacerbated, in a lot of ways what was going on, and we had. The Wharton professor, I think it was, asking for a 75 bip rate cut, and now he's reversed off that. And, we're not thinking about earnings. And I think you have Airbnb over there. And here we rent houses generally, but I know you rent flats there when you go on your posh little trips. But, these earnings weren't that great. I know Home Depot yesterday was also not terribly good. I think, stock clearly not reacting like Airbnb does, but there still is this issue of the recession, which initially last week everyone was worried about it. Now, of course, just because of a little bit of good S&P price action, we don't care about that anymore. So my takeaway here is I think things are very unclear about where we stand today versus, a week from now. After Nvidia earnings, we have a much clearer picture and things will make a lot more sense.
There's two other factors that are creating upward drift in this market, in my opinion, right? One is corporate buybacks have restarted in size after the earnings are out the way. And we're talking about $5 billion a day, which is chunky and has market impact, right? So that's going to put some sort of, support into the market, all things being equal. so that can counteract some of the other bearish things that are out there. And then also the fact that skew has exploded so much, and you look at it, it's still quite high in the range, right? Skew, it's come back from the highs, but it is still quite elevated. So that tells us that the street positioning is likely to be short puts and long calls to an extent, right? When the skew is that high. So when the skew is that high, again, just the passage of time creates a buying impact through Vanna and Charm, right? Because those options that have delta hedges against them, that they're quite pumped in terms of that skew. Not only does it tell us that the positioning is that way round, where dealers are short downside and long upside, so that gives us more conviction that the Charm and the Vanna is that way round, but also there's more delta to kind of be burnt off those options. And as that happens, there's a delta cover effect, basically, right? So I wonder if those two natural buying flows in the market are enough to support these markets, and then we continue to work our way back to like 5,600 and beyond.
Yeah, I think to your point, the default direction for the market is higher, and I think there's all that discussions on passive inflows and all these other effects, and we still have the JEPI and the call overriding and all that stuff. And so if we hold in these general areas, there's stability with higher price drift, and I think to your point, that's the default way that these markets work until there is some kind of paradigm or data point that really breaks that down. And Imran, we're getting sort of the top of the hour, so I just want to talk quickly about the macro view from the macro equity view here as we're getting some of those questions. Again, if you want to join Imran and I for our OPEX conversation where we get into specific single stocks around what's happening on Friday and look at a couple different trade ideas, you can scan that QR code. You could also go to spotgamma.com/OPEX. When you download that spreadsheet, you get a link to the private Zoom call for that, where we talk about some interesting trade ideas more specifically. So please join us there. The way that I'm looking at this, Imran, is if we lose this 5,400 area, we still have a little bit of stability, I think, down to 5,300. It's when we lose 5,300 that we start to get into more of this negative gamma dynamic and things get a lot more slippery. I was on record as saying I think 5,400 was a big resistance line, maybe 5,450, but I'm prepared to say right now we're kind of really solidly at my resistance line that I was looking at into OPEX on Friday, because I saw positive gamma in and of this general area. And so I thought this would really keep a lid on things. Now, if we get a good retail sales number tomorrow, then I'll probably be wearing that 5,400 area was resistance. But if we break this 5,400 area, I think by and large it's going to be pretty slippery downside. Not catastrophic, but pretty slippery downside into Jackson Hole. And as far as the VIX goes, I still don't, maybe I guess VIX 15 has to be in the mirror now. But I just think we're generally not going to get a real solid volatility. We're not going to see the same vol levels we did before this crash until after Jackson Hole. So, a slow rate of decay is, I guess, what I'm saying. But I also thought the VIX would hold around 20. So I've been a little off on that view as well.
One thing I'd say about the VIX, right, is you got to bear in mind that selling VIX has become such a popular trade, right? And if you're going to sell VIX after next week, September's the only one you're going to sell, because October contains the election, and you're not going to want to mess about with the election premium, right? Because you don't know, because there's the uncertainty of the elections actually rising, not falling, right?
Right.
So I feel like September's going to benefit. When I say benefit, September VIX is more likely to get smashed because it's the only thing that's going to be safe to sell, right?
It's a good point. And my thought was Jackson Hole next week. Okay, great. We get a little relief from that, but then you got to deal with the mid-September rate cut. And then we're kind of right into the election season and the focus on that. So, can vol really fully mean revert to where we were before? I mean, I guess if Nvidia earnings crushes it and the market hits a new all-time high kind of thing, then maybe relative election vol premiums come down a little bit too. But you bring up some very salient points.
Yeah, I think it's all one of those. Like I've been guilty of this many over the years. Like when vol spikes like crazy, and people get stopped out, and it's like, oh my god, there's volatility again. And as vol traders, you get excited and you're like, oh, finally, there's something to trade, there's something to do. But just never underestimate the propensity for vol to go down, right? because it so does, and all it does is it's easy to buy because it's come down so much and it looks so appetizing to buy, and you think to yourself, wow, I'm getting discounts here, right? A week ago it was trading at 50, now I can buy it at 15, and guess what? That is the wrong thing to do, because it goes to 12 and it goes there quick because everyone thinks the same, and there's no actual reason to buy it, right? So I think that's the thing. Whether we get a 50 bip cut or a 25 bip cut, it's still a cut, right? And the market a month ago was all excited about cuts, and it's either a cut or a double cut. Those are both positives to the market, right? Really, right? So I just feel like if we zoom out a bit and realize that, then I'm not sure that the Fed cut, whether it's 1 or 2 cuts, is really a big deal. Liquidity taps are on. The hiking cycle is done. It's history. We've got the green light from growth. We've got the green light from inflation. And the only thing that can spook the market really is the election. And that's why I think, they won't sell the election bucket. The election will hold some vol premium. But I think I would not be surprised to see short-dated vols mean revert pretty damn quick.
All right. So Imran is I could phrase that as uber bullish. Is that fair to say?
I'm uber bearish vol. I don't know if I'm uber bullish market. But that's why I've been expressing my trade via the VIX, right? I've piled into September, October VIX calendars and to play September lower because it was mispriced in my opinion. And now it's heading the right way again. And it's just, that's for me, that was the highest conviction trade I've seen pretty much all year. And that is why all my subs know what I've been doing there.
Yeah, and I would say this about this vol spike the past week. I mean, with VIX at 50 plus, playing short vol from those levels made a lot of sense. And what I saw on Twitter and our Discord channels and everything else was everyone was waiting to play that move because volatility mean reverts, and people were heavily expecting that, and they were clearly right? And I think that there's a difference between saying, hey, I need to, I don't want to short vol, but that doesn't mean necessarily that it's a buy. And my concern here is that there is a fragility in this market, and it was just exposed and shown in full colors here on last Monday, such that you can say to yourself, great, I can bet on vol going, let's just say VIX going from 50 to 25, and there's a lot of value in that. And now we're getting in this area where it's like, well, VIX may have another 2 vol points or whatever to go down. What's the risk reward there of trying to necessarily short that stuff? We saw,
but there is no risk reward. There's no risk reward in selling futures here, right? I agree with you. But but anyone in their right mind doesn't sell VIX futures here, right? Like that's just mental.
Well, that's what I don't know. I mean, I think a lot of people, you had said that a lot of people think vol is cheap, and so you want to buy it here. And I actually think what I saw out of this was like everyone wanted to sell vol, and it reminded me a little bit of 2017 because everyone was short XIV, and then anytime we get a little vol pop, it's like, ooh, yes, free money's coming here. I'm gonna say, and then that worked and it worked and it worked, and then suddenly it had built up this, hey, the VIX is at whatever it was 30. This is guaranteed free money, and then then there's this like explosion that washes people out. And so some people got margin called on Friday. There was clearly a bunch of trades that were stressed and forced out, but by and large, people were okay enough to re-enter these trades or position into selling vol back down and various forms of correlation, whatever it is. And if that goes bad, in some way because of some of this data coming up, I think it's going to be very nasty again. And I don't know that the risk reward is that great here of saying, hey, let's short vol. Like, okay, you want to get long equities because Nvidia is going to be good and all that. I think that, can make some sense. But
but the way you short vol right now, you don't sell calls on vol. You don't sell futures on vol. You own puts, put flies, put ladders, put ratios, maybe broken wing flies, whatever it is. You use VIX optionality to play that roll down. You don't sell unlimited loss structures because you're going to get your head chopped off, right? And you've literally just seen it. So why would you be stupid enough to? And the truth is, if you're institutional money, you're probably not even allowed to do it now because all your VAR models have just shown what can happen in the VIX. So you're not allowed to do that stuff, right? So bear that in mind, right? If no one's allowed to sell vol, well, vol's probably going lower, right? You see what I mean?
Yeah.
So I think professional money is going to struggle to like go and slap vol out the door and take loads of outright risk after what we just saw happen to all the vast shock that we just saw, right? So, I would only advocate selling vol in safe ways. There are ways to do it that can keep you safe. And those for me are the higher conviction bets right now, outside of just buying S&P.
And let's cover that some of those VIX put structures that you mentioned in the follow-up call that we have at 1 o'clock. And if you're 11 o'clock, if you're interested in that, spotgamma.com/OPEX, or scan the QR code up there, and maybe we can kick off with Imran showing us some of the VIX put structures that he likes. And then Kim Reederson also mentions geopolitics. That one is always lying here in the corner. If missiles do start flying, hopefully they do not. That is always this kind of lurking risk, right? That's around the corner. You can't bet on that.
It is, but this half-life of that it decays very fast.
Very,
right? So,
very well, very well said on that. Yeah,
it's like, you know what I'm saying, right?
Yeah, 100%. It's the boy who cried wolf scenario, and so we all kind of stop paying attention to it, and hopefully nothing happens there. But at any rate, that'll about wrap it up for us here. Imran, again, spotgamma.com/OPEX. Imran, thanks so much for a lot of the great views you had today. You and I are differing a little on opinions today. Usually we're synced up on stuff, so I always like that. Yeah. Where can people get a hold of you if they are interested?
Yeah, sure. So options-insight.com is our website. Come check us out, see what we do. I'm pretty active on Twitter as well, at options_insight. And then I've also got a crypto options podcast called Crypto Options Unplugged, which is fast becoming the go-to podcast in crypto, because we do a bit of macro in there as well. And I talk about what I'm seeing in crypto vol. So if you guys are able to trade crypto vol and want to trade crypto vol, it is a quite an exciting place to be with lots of opportunity.
I think that's still a little bit difficult here in the US. Not quite as easy in the US as I think it is.
Yeah, it is. You can't trade on the big exchange Deribit, which is kind of the crypto options exchange with all the market share. But what you can do is you can trade options on stocks like Mara, Coinbase, MicroStrategy, things like that. So there are ways to get involved.
Great. Thank you for that. And Imran's been doing some excellent subscriber Q&As for us here on Mondays and Wednesdays. So if you're a SpotGamma subscriber, you can see him, or you have seen him working on trade structures, which have been super helpful for us. So we're appreciative of that. You can find me on SpotGamma.com, at SpotGamma.com, or at SpotGamma on Twitter. This replay is also live. I see a couple people say they just got here. You'll find this on our YouTube channel as well. So please go and check that out. And hopefully we'll see all of you in a few minutes on the Zoom webinar. So thanks so much. And we will see you at a minimum